Imagine a bomb that never explodes. No sirens, no mushroom cloud, just a slow, steady evacuation, one suitcase at a time. That's the 2026 story hiding in plain sight, not a dramatic end of the dollar headline, but a gradual change in where big players park their national savings. Some analysts call it sovereign capital flight. I'll call it a stress test. What happens when a major holder stops behaving like a permanent buyer? Today we'll unpack the numbers behind China's drawdown of US Treasuries, the parallel rise in official gold, the payment rails being tested outside the traditional dollar plumbing, and the reality check that keeps this grounded. This is a market story, not a political speech. It's also education, not financial advice. Picture the US Treasury market like the world's biggest, safest parking garage. For decades, countries earned dollars through trade and then parked those dollars in treasuries. Liquid, deep, easy to sell, and accepted everywhere. If you're a central bank, that parking garage is convenient because you can move billions without asking permission from anyone else. Now imagine one of the biggest customers starts backing out, slowly. Not because they hate the garage, but because they want multiple exits. That's the mood shift. The nuke in numbers. Start with the hard data. According to the US Treasury's TIC report, China's reported US Treasury holdings were about $682.6 billion in November 2025. For context, in the early 2010s, China's holdings were above $1.3 trillion. That's not a small trim. That's a multi-year reversal. Now look at the gold flip. China's official gold reserves rose again through 2025, reaching about 74.15 million ounces by the end of the year, an all-time high in their official series. In plain English, while paper debt exposure falls, gold allocation rises. Here's what matters. This isn't a single trade. It's a policy-like rhythm. Less paper claims, more neutral reserve assets. But before we jump to scary conclusions, widen the lens. Foreign holdings of US Treasuries actually hit an all-time high in November 2025, about $9,355 trillion. Japan was around $1,202 trillion, and the UK was about $888.5 billion. So the story isn't no buyers. Its buyers are changing, and flows are rotating. The old model. Why they bought so much in the first place. To understand the shift, you have to understand the old machine. For years, China ran a massive export engine. Exports brought in dollars. Those dollars, if left alone, would push the yuan up. A stronger yuan makes exports less competitive. So what did the old playbook do? It recycled dollars into US Treasuries, partly as reserve management, partly as a way to stabilize the exchange rate. Economists often describe the companion operation as sterilization, using domestic tools to offset the monetary effects of those inflows so the local system doesn't overheat. Think of it like this. Dollars come in, you park them in treasuries, you manage the domestic side so you can keep running the export model. That's the old world. But 2026 is not the old world. When global supply chains get more fragmented, and when reserve access becomes something countries worry about, priorities change. Cheap exports are not the only goal. Resilience and optionality rise in the ranking. So the new playbook is closer to hold fewer claims on one system, hold more assets that are nobody's liability, build more routes for trade settlement so you're not stuck with one lane. Why a slow sell can still hit hard. But the treasury market is huge, you might say. True, it's the deepest pool on earth. Yet even a deep pool can slosh if the timing is wrong. In bond markets, price is set at the margin. If a large buyer reduces purchases or sells into thin moments, yields can rise, meaning the US government, households, and companies face higher interest rates. And that's where the pressure point lives, the rollover machine. The US doesn't pay off the entire debt tomorrow. It refinances, constantly. So the real question is, at what interest rate? When yields move up, debt service costs rise too. The US gross national debt is in the high 30 trillion range, and interest expense has become one of the fastest growing lines in the budget. Even if nothing breaks, higher refinancing costs squeeze future choices. Now here's the trap people dramatize. So let's say it cleanly. If yields rise too fast, the Treasury must pay more to borrow. The economy feels tighter financial conditions. And the central bank faces harder trade-offs. Keep policy tight to control inflation or ease to support markets. No conspiracies needed, just arithmetic and incentives. So the nuke isn't one big sale. It's the compounding effect of higher refinancing costs over years, if demand shifts at the margin. The payment rails story, the quieter part. Holdings are one side of the chessboard. Payment plumbing is the other. Reserve demand for dollars comes from three big places. 1. Trade invoicing and settlement. 2. Safe collateral and deep markets. 3. Official reserves. On the third point, the IMF's COFR data shows the dollar's share of allocated reserves has drifted down to about 56% in 2025, still dominant, but lower than decades past. Important nuance. Part of that movement can be valuation effects when exchange rates move, so we don't overinterpret one quarter. But the long slope matters. Now layer in the experiment phase. In mid-2024, the BIS said Project mBridge reached an MVP stage, basically a working prototype for multi-CBDC cross-border settlement using a shared platform. And in January 2026, Reuters reported that India's central bank proposed linking BRICS CBDCs to make cross-border payments easier for trade and tourism, an idea that could be discussed at the 2026 BRICS summit. What does that mean in real life? It means countries are testing a world where a buyer and seller can settle directly with digital central bank money, with foreign exchange happening inside the same platform. Fewer intermediaries, fewer delays, and potentially fewer touch points that require dollars. Notice what these projects attempt. They don't need to replace the dollar everywhere. They just need to reduce friction in specific corridors. Because if enough trade settles without dollars, especially in big industrial supply chains, then the world needs fewer transaction dollars, even if it still wants reserve dollars. That's the quiet mechanism people miss. So the financial nuke is better described as a slow structural repricing, not a bang, but a gradual reduction in default demand at the edges. Reality check, so we don't go full doom. Reality check 1. The depth problem. No other asset matches US Treasuries for scale, liquidity, and the ability to move huge sums quickly. Gold is valuable, but it's not a yield-producing, instantly deployable collateral pool of the same size. And alternatives, euro markets, yen markets, or local currency debt, have their own constraints. Reality check 2. Selling too fast can hurt the seller. If China dumped aggressively, it could push prices down and damage the value of what it still owns. So what we usually see is a managed glide path, not a panic. Reality check 3. The silent buyer effect. Even while China reduces, other holders have increased. Japan and the UK have both been large holders recently, and overall foreign holdings have risen to records. So coordinated attack is a strong claim. What the data supports more clearly is diversification plus a shift in infrastructure. Reality check 4. Custody can mask the picture. A country's exposure can be held through financial centers and custodians. So the headline, "Who holds what?" sometimes hides the chain of ownership. That's why you watch trends, not just one country label. So no, this isn't an overnight demolition. It's a slow rerouting. If you want to follow this story without getting lost in headlines, watch the plumbing. Monthly tech updates, who is adding, who is trimming, and whether the declines are gradual or sudden. Auction health, bid-to-cover ratios, tails, and indirect bidder strength, a proxy for foreign demand. The dollar's reserve share trend in COFR, slow but telling. Official gold updates and central bank buying reports. Cross-border payment pilots, CBDC linkages, mBridge-style platforms, and real-world usage beyond small tests. FX swap stress. When dollars are scarce globally, it shows up in funding spreads before it shows up in speeches. And here's the key mindset. The financial nuke is not a secret button. It's a sequence. Reallocations, new rails, and changing incentives. So the real question for 2026 is this: are we watching a temporary cycle or a permanent rewiring? If the dollar is still the biggest parking garage, but more cars are building garages at home, then the future isn't collapse, it's competition, and competition changes pricing. Tell me in the comments, is this just normal diversification or the beginning of a new reserve era? And if you want the next video, we'll map the 3 scenarios from here: slow fade, sudden shock, or a surprisingly stable middle path.